Good morning, everyone. It's Tuesday morning. Actually, it's Monday afternoon on Labor Day, August 6th, but I won't release this till tomorrow morning on Tuesday. I hope everyone had a great Labor Day weekend and welcome to the fall. Believe it or not, leaves are already starting to change up here in the Rockies. Our note this week was a little shy on words. We titled it mostly charts and labor bottlenecks. We did have a fair bit of description of the labor market and the incoming data, but it really was all about charts and trying to tell the story of what we think is going on through all the charts that we published in the note this week. By the way, to get all those charts, you have to be a full paid subscriber. We'd love you to consider becoming one. We have pushed off the timing of making these podcasts or putting them behind our paywall. For now, we're going to continue. We have some things going on in the technology front. So the note this week was comprised of three sections. There was a market recap, a macro data review discussing the incoming housing data, consumer confidence data, manufacturing data, capital investment data, and of course, the third section of the note was all about labor market bottlenecks. It was somewhat ironic that right in front of Labor Day, we did have a very interesting labor market report. So first on the market recap, we want to just go back and discuss a little bit our call for a correction occurring in the near term. We made this call in late June. The markets continue to grind higher. We do think we're at a fairly key inflection point, but we should go back and review our basic framework for 2021, which was we thought all corrections would be limited to 4 to 6% until and unless we had a policy tightening. That policy could be either monetary or fiscal policy. We became convinced after the June FOMC that we were going to get a September tapering announcement or no later than September. Obviously, there's some increased uncertainty with respect to that after Friday's big headline miss. We'll come back to that. However, we're also going to be looking at fiscal policy tightening in as much as on balance, the fiscal authorities are going to be spending more money, but as it pertains to equity investors in particular, we're looking at a tightening of policy in as much as the primary pay for of this spending on human infrastructure is an increase in the corporate tax rate and restructuring of the corporate tax code, which could largely unwind the Tax Cuts and Jobs Act, an issue we took on in the previous week's note. So that would constitute a policy tightening as well. We also think we are at an inflection point in liquidity. The drawdown of the Treasury General Account from $1.7 trillion to its current level of roughly $265 billion is largely complete. So that liquidity dynamic that kept the capital markets so buoyant has reached an inflection point. We also think we've reached peak growth, though we had something of a growth scare 3 or 4 weeks ago. We seem to have transitioned past that to an extent, but those who are thinking that second or third quarter earnings season is really going to boost equities, we think that's unlikely to be the case, and we just have gone past that point of peak growth. Earnings will be supportive over time, but not a catalyst for keeping the market momentum going through the course of the fall. And then, of course, there's negative seasonality. Now, we fully recognize that if we don't get either of these policy tightening events, if the Joe Manchins of the moderate part of the Democratic Party push back hard on this, and there isn't a significant retraction of the Tax Cuts and Jobs Act, and the taper process does get pushed out till the very end of the year seasonality could push any correction into January. So we have to admit that the probability of grinding through typical volatility season has gone up. That's still not our call. We think on balance, we should get a correction for the reasons we just discussed. But nonetheless, that big headline miss does increase the probability that we don't get any significant policy tightening until 2022, I should say. So on the macro data review front, the first big numbers of the last week were the housing numbers, and they're off the charts. House price correlation is at 0.97% as measured over 3 months or 6 months using the 20 cities that comprise the CoreLogic S&P price index. This is far higher than was the case in late 2005, 2006. House prices are even stronger than they were back then. This doesn't prove that macro factors like the Fed buying 100% of the net supply of agency mortgage-backed securities is the root cause, but boy, it sure looks like a duck, quacks like a duck, and I don't know what else a duck does. But nonetheless, the Fed should not be buying 100% of the net supply of agency mortgage-backed securities. We moved on to discuss the weak consumer confidence numbers. And if you could see it in the conference board series, the inflation numbers are just surging. That looks like the real root cause of the drop in consumer confidence that was evident in both the Michigan and conference board numbers, as well as the morning consult series as well. The next issue from last week we thought was surprising, and perhaps one of the most surprising parts of all the data last week. We actually felt that the new orders portion of the ISM series was probably the most surprising number of the week. That seems a little bit incongruous to say in light of the headline miss in payrolls. But that actually is a frequent occurrence in August payroll reports. We did a lot of work on this back in our BlackRock days. There was a series of misses in August in the early 2010s that then got revised significantly higher. But that orders series going significantly higher in ISM was pretty surprising, because we thought we'd reached the maximum point based on those regional Fed series where that would start to roll over. What was also interesting about those payroll purchasing manager series last week was how weak Asia is relative to the West. Germany and the US in particular are right up close to their highs, and Asia is decidedly weaker. Now, there's a couple of reasons for that. One is pandemic policy, the way they approached the pandemic, trying to eradicate the virus as opposed to just controlling it. And the West, given the liberal democracies that they live in, never really had the ability to try and go for eradication. So they're having their second wave of it, and it's causing increased labor market bottlenecks. But it does speak to the longer term trend towards deglobalization as well, and the likely struggles that we expect to see in Asian manufacturing in the coming decade. Moving on to the US inventory restocking, manufacturer inventories from the ISM series are now up towards the highs that you see for them through time, through the last 20, 30 years. However, customer inventories are still near all-time lows. So while we think that that inventory stocking process will come much more into balance in the second half of the year, or even final 4 months of the year, it won't be the big driver for stock prices that it was when we were anticipating the inventory restocking process. But we have to admit, as we said, those orders, ISM US manufacturing orders, were quite impressive in the month of August. So we would, our call that we have reached peak manufacturing recovery may be a couple of months early. Finally, on the capital investment front, we dug into that a little bit, at least through our charts, and would acknowledge that the equipment orders recovery has probably peaked. Structures are just getting started, and software is likely to continue to be strong. Bottoms up S&P 500 capex is just getting going, and we think those numbers will be impressive in the coming quarters, and probably will be good news for productivity on a go-forward basis, margins, and S&P 500 earnings. So on to the labor market. The policy implications of this are not quite as clear as you would think, given the headline miss. To be sure, those of the FOMC participants focused on bottlenecks and supply side issues will be probably, if they look at these numbers carefully, and we'll come back to this in a second, will be even more convinced that the Fed should be tapering. But the Keynesian crew, which will be out in force next week, we're going to hear from John Williams, we're going to hear from Mary Daly in particular, and Charlie Evans. They are probably going to be pushing hard to push this decision out till November till we find out more about whether schools stay open, more about what happens with the unemployment benefits that ended today. They'll be no doubt describing it as a benefits cliff, and they will undoubtedly want to wait. What's a little unclear is how Powell and Clarida are going to react to all this, whether they'll be swayed by the arguments of those focused on the supply side, or whether politics will push them for making any hard decision. Now, we've been saying that we don't think the politics are quite as clear cut as many of our clients believe. It's not administration wants low rates like President Trump was so adamant about. This inflation risk is growing for the Biden administration, as evidenced by the op-ed that Joe Manchin wrote in the Wall Street Journal that we provided a link to in our report this week. So the Powell-Clarida dynamic is a little unclear. We're not going to hear from either of them this week. So we're just going to have to sit and think about this a little bit. But when we looked at the report, here's what we saw. We saw a lot less slack. The measures that go into our labor slack index that were reported on Friday, the U3 unemployment rate went down. The U6 unemployment rate went down. The long-term unemployment rate went down. Labor force participation rate for prime age men went up. The employment to population rate for prime age men and women went up. The median duration of unemployment, how many weeks it takes to find a job, went down. Permanent job losers went down. Discouraged workers went down. The NFIB survey was off the charts in terms of lack of labor market slack. And of course, the price for all this, wages, was up much more sharply than expected. It's running at a 5.8% annualized rate over the last 3 months. Wage growth is strong. This is Powell's inflation dynamic that he discussed at the last FOMC press conference, or the inflation process. This all argues for less Fed stimulus. Nonetheless, we'll see what the Doves have to say this week, and we spelled out, I think, as best we can where we come out on all this. Yes, it reduces our confidence that they go in September. We obviously think they should be going in September. We think they will be going in September, but it's obviously not. We had to have a little bit less conviction after that headline miss, which, by the way, we think was likely biased, but by that seasonality we discussed earlier. And the BLS actually printed a section in their report, which again we referenced in our report, that basically said they had no idea what's going on with teachers. They have no idea why we didn't see a surge in teachers, even though there's far more teachers back in the classroom this year versus a year ago. So that's it for me this week. That's hopefully a pretty good summary of what we essentially walked through in pictures, in charts, and with a bit of verbiage this week. And not a ton of data this week, but we'll have a more complete assessment of all this in next week's report. Have a good week, everyone. Welcome to fall. Thanks.